A viewer named Steven emailed me recently asking me about an ETF. It's called Avantis All Equity Markets ETF. It was launched just this year. Here's what Steven had to say. He said, "A huge fan of your channel. I was wondering if you could make a video going over AVGE, that's the ticker, AVGE, Avantis All Equity Markets ETF. I believe many viewers would be interested in hearing your thoughts about this fund as sort of a one-stop shop equity ETF." And so that's what we're going to cover in today's video. My name is Rob Berger. This is the Financial Freedom Show, where we talk about investing and retirement, and maybe even more than just retirement, achieving financial freedom. If that's of interest to you, I encourage you to subscribe to the channel. I also send out a free newsletter every Sunday with articles that I think are useful for those topics, and you can subscribe to that in the link below this video. So let's dive right in. Avantis is a relatively new fund company. We'll actually talk a bit about its history and sort of why it came into being in just a minute. But its newest ETF is a world stock ETF. The idea is you can just invest in this one fund and you get exposure to both US stocks and stocks of companies headquartered outside the United States. In theory, you could just use this for your stock allocation in your portfolio and nothing else. And the question becomes, all right, well, how do they construct this portfolio, and is it worth considering for really taking over all of the equity in our portfolio? So let me actually show it to you now. Here we go. This is the Avantis website. I'll leave links to all of this below the video. Let me pull it up a little bit so you can see it. So the first thing I always look at is expense ratio. So this one, the net expense ratio, is 23 basis points. Now, all things considered, that's not unreasonable. Things to keep in mind, though, I think the fund industry and financial management industry in general tries to condition us to think that maybe even 1% is reasonable. The reality is a 1% fee, whether it's from a fund or an investment advisor, is nothing short of outrageous. 23 basis points is not outrageous, but it is significantly higher than other options. For example, Vanguard has a fund that covers all equities across the globe. It's ticker VT. We'll actually look at it briefly, perhaps in a minute. It's 7 basis points. So I don't see 23 basis points as ruling this ETF out as possibly a reasonable choice, but I do think it's at the high end, and that's how I think we should view these expenses, because they really do take a chunk of our money over time. As I mentioned, it's an all equity markets ETF. Now, what does that actually mean? We can look at its portfolio. This is a fund of funds. So here's its portfolio. It holds or owns 10 other Avantis funds. That's what it does. That's how it constructs the portfolio. And you can see over here the name of the fund, which gives you an idea of what it invests in. So the U.S. equity ETF is U.S. companies. And you can see here the weight, 44.36%. The thing I want you to notice here, as we go down this list, we have large cap value. Then there's international emerging market. Then we have international large cap value. We have small cap value, and then just small cap. Then we have an emerging market value and an international small cap value. You'll notice in that list, there's a lot of funds that are tilted towards value, and a good number of funds that are tilted towards small companies. We're going to talk about why that is. It's a really important thing to understand when it comes to Avantis and really all of their funds. And so we'll talk about that in a minute. Now, in terms of performance, we don't have much data. And the reason is the fund is brand new. In fact, you can see they don't have any year-to-date numbers. They don't even have 3-month numbers for this fund yet, because it's that new. They have 1-month numbers. The thing I want to point out here is the benchmark. They're using the MSCI World Index. We can look at it here. There's a fact sheet. I'll link to this below the video for those that are interested. But this is what they are using as their benchmark. And so going forward, that would be the kind of thing that we might want to compare this fund to. I would also, by the way, compare it to VT, the fund I mentioned a moment ago. This is Vanguard's sort of similar fund, but definitely different in many ways, but that covers the entire sort of global stock market. But getting back to Avantis, I think the first thing to note, and I'm going to actually show you this in Morningstar because it's just a bit easier. Their US to non-US split, you can see it here. It's roughly 71 I think it's probably today maybe closer to 72%, and 28, maybe 27% non-US equity. So that is notably less than VT. VT is not, I wouldn't call it significantly different, but when we look at North America, it's around 65%. So VT has about 65%, we'll call it US companies, and 35% outside the US. The Avantis fund says, yeah, that's too much international for us. So at the moment, they're around 27% international. Now, in a perfect world, I'd like to keep my international exposure to around 20%. That's just my comfort level. There's not necessarily a right or wrong here, but it is one of the things that you need to keep in mind if you're going to consider any sort of global stock ETF. You have to kind of accept their allocation between US companies and international based companies. For me, between the two, I would prefer Avantis because it doesn't have as much international exposure as VT does. Now, given that though, there is one other thing we need to look at. This is the summary prospectus for the Avantis fund. And I'll leave a link to this below the video. But the reason I point this out, you see US equities has a target weight here of 70%. And then you've got 17% for non-US developed countries and 10% for emerging markets. And then there's some real estate at the bottom. So this is their target, 70% US, 27% international. You might throw this 3% into US potentially, but it's a relatively small amount. The thing I want to point out though is they also have a range. So while this might be their target, the range can be significantly different. I mean, at the high end, the international could be what? As high as, if you add these two together, you get 41%. Now, whether it will ever get that high at various times, who knows? But I do point that out, that the US to non-US allocation that exists today will change over time. Now, it may not change significantly. We'll see. We don't have a lot of history for this fund yet to know for sure. But it will change from time to time, and at least in theory, according to their prospectus, it could change pretty significantly. So that's something to keep in mind. Now, once we understand that, I think the bigger question is, how does Avantis decide on what goes into this fund? The thing to keep in mind is, this is, in theory, an actively managed fund. Now, they have systems that allow them to pick the stocks that they do. It's not tracking an index per se like VT is, but it is sort of tracking a model that Avantis uses. And we have some insight into that model, not just for this fund, but all of their funds. And it's something I think we need to understand when we consider any of their funds. And I want to show you an article. This is from their website, although it's, at least at the moment, not available on their website. When I go to the URL, I get an error. So I've taken that URL and put it into what's called the Wayback Machine, which sort of archives much of the internet. And so I'm able to see this article. I will leave a link to this so you can check it out yourself. Now, I will tell you a lot of what's behind the contents of this article. It's very sort of academically based, but we can maybe at a conceptual level, let's talk about it, and then I'll point out a couple of things in that document that can help you out. Of course, you can read it for yourself as well. So if we go back in time, we think of someone, a professor named Sharp, who came out with what's called the capital asset pricing model. The idea behind it was to figure out, what causes stock prices to go up and down and expected returns. And what he developed, call it 50 years ago or more, was this idea there's a single factor. And one way to understand it is to think about investing in one company versus, say, the S&P 500. If we were to invest in Apple, there are going to be some risks in that investment that are unique to Apple, right? So maybe, I don't know, the iPhone goes out of favor and no one wants to buy one anymore. Or if it's Tesla, it's that something happens to Elon Musk and he can no longer lead the company. Those are risks that are very specific to one company. We can compare that to market risks. All stocks are just, by virtue of the nature of of what they are, they have sort of a systemic risk that you can't really avoid. You can avoid the risks of an individual company by, for example, investing in the S&P 500. You can minimize those company specific risks, but you can't really avoid the market risk as a whole. And so the CAPM, the capital asset pricing model, that was sort of the idea behind it. And sort of the takeaway was there's this one factor, this sort of market risk. And so your best bet just to own the market, which in many ways is what came out of that research, are the index funds that we know and love today. Think of the Vanguard first index fund came out after that research in the 70s. It's a one-factor model. All right, well, a couple of guys named French and Fama, professors in 1993, came out with a paper and they said, that factor is important, but we think there are two other factors that are also important. One of them is the size of the company, and they found that you can get some maybe extra return focusing on small companies versus big companies, not exclusively, but perhaps tilting your portfolio towards small companies. And the other factor that they said matters is value versus growth, right? Value, you can think of it as companies that are undervalued relative to their revenue and their earnings. And so they called it the three-factor model. We had the sort of the overall market risk that Sharpe wrote about years earlier, and we've added small cap and value. Out of that research came Dimensional Funds Advisor, which is a fund family that you may be familiar with, DFA. And they had a lot of small cap and small cap value funds that a lot of other companies, including Vanguard, didn't offer. And it was sort of based on that Fama French research. Well, guess what? Not to be outdone, Fama and French came back years later and said, we had a three-factor model, but now we think it's a five-factor model. They added two factors that, generally speaking, had to do with a company's profitability. And they have ratios and formulas that they can use to evaluate this. But they said, look, small in value, important, but we also have to look at the nature of the profitability. And from that research, we have Avantis. They've sort of embraced that, and they do some profitability analysis. And I can show you in this paper, for those that want to go research it later, two of the key formulas or ratios that they look at are equity, which you could think of it as book value divided by price, and profits divided by book value or equity. And this paper goes into more detail on it, which I'll let you read if you're interested. By the way, I do think it also has a nice chart that shows sort of a lot of the key research and papers on asset pricing. You can see actually Sharpe is here, 1964. By the way, we can go all the way back to 1959 for Markowitz. And then we have the three-factor model right in here. And then more recently, you can see a lot of profitability research that's gone into it. They don't actually mention Fama and French's five-factor model, but basically the idea is we can go beyond small and value and look at the nature and of the profitability of companies. And so that is what they have done in their funds. Now, the big question becomes, all right, Rob, appreciate that history. All I want to know is this going to outperform? Well, the short answer is we don't know. There's no way to know. The current fund that we're talking about was just launched. Now, some of the underlying funds that are in it have been around a little longer, but we're only talking a couple of years. So the reality is any of the Avantis funds that you might want to invest in, you are taking a risk that the profitability analysis that they are doing in order to pick the companies that they're going to invest in is going to outperform on a risk-adjusted basis, say, a more standard plain vanilla index fund. I have no way to tell you if it's going to work or not, but it's something that you need to think about before you invest in any of their funds. Now, my sense is, even if it turned out that it didn't work, it wouldn't be disastrous. I don't see these funds underperforming, say, their most comparable index by some wide margin. The bigger question, though, is why do you want to take the risk at all? I think in some of their funds, I think small cap value, for example, they may give us exposure to small cap value in a way, that other funds can't. Going back to this fund, the All Equities ETF, I kind of feel the same way. When we look at their portfolio, let me go back to, we'll look at it again on their website. Here it is. I like the fact that it emphasizes small cap stocks and value-oriented stocks more than, say, VT does. VT certainly has exposure to small companies and value companies, but only as part of an overall index that's sort of covering the market. Now, if you are a sort of diehard boglehead, you would absolutely prefer something like VT, or maybe you construct it on your own with a US stock fund and maybe an international stock fund where you can control how much is in each, but you're still just sort of covering the market. You're not trying to get fancy with 3-factor and 5-factor modeling and extra exposure to small cap and extra exposure to value. And I think that's probably, maybe I'll call it the safest way to go. Safest in the sense that you're not making any bets one way or another. You're just buying the market. But for many folks, they do want that tilt towards smaller companies and value. Let's be honest. It's frankly because historically, those things have done well. Whether they'll do well in the future, well, your guess is as good as mine. Having said all of that, I do like this fund. I haven't invested in it. I'm not in any hurry to invest in it. I may or may not in the future, but I do like it as a one-stop place to get all of your equity exposure. Having said that, because it's unproven, because the fund family here is so new, I would not put all of my equity exposure into this fund or into this fund family. I'm just not confident enough. And that actually presents sort of a practical problem, because one of the benefits of a fund like this, just like VT, is that you can just put your stock allocation in one fund and be done with it. I'm just not comfortable, wouldn't be comfortable doing that until I had some better sense as to how these funds are going to perform. And that could take a long time. This is a new, as I mentioned, a new fund family, and they're taking, I think, a unique approach to constructing their portfolios. And so the real key is, I think, you are taking some risk in any of their funds that the approach they're taking maybe not doesn't work out in the long run. So that's my take on this fund. Is I like what they're doing. I like the small and value tilts. It's consistent with my own thinking on investing. I like its US versus international percentages better than, say, VT, for example, although it's still a little rich on the international side. But I would say for me, it's within the range of reasonableness. And I even like that they're focused on profitability the way that they are. I think this has the potential of doing very well. The big caveat is it's all brand new. And sometimes new shiny things are not really worth taking the risk to invest in. Ultimately, that's a decision you have to make for yourself. So that's my take on the portfolio, or on the fund. A lot of good things with a lot of cautious, not so sure, brand new kind of concerns as well. Again, I'll link to everything I talked about and showed you in the video, below the video. If you have any questions, leave them in the comments below. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.